You're watching your financial life unfold in slow motion. Inflation has finally arrived. Your gas, your groceries, your rent, everything costs more. The central banks, from the Federal Reserve to the European Central Bank, all swore they could control it. They promised they could print trillions of dollars and just pull that money back when things got too hot. But what if this inflation is not a sign of a strong economy? What if it's the final, flickering illusion before a much darker, deeper crisis? A structural crisis that central banks are completely powerless to stop. I'm not talking about more inflation. I'm talking about its terrifying opposite, deflation. You probably see Japan as a historical curiosity, a strange land of zero interest rates and economic sleepwalking. They call it the lost decades. But Japan's story isn't a curiosity, it's a prophecy. It is the exact blueprint for a catastrophic asset bubble collapse that proves printing money alone cannot stop a deflationary spiral. The ghost of Japan is already haunting Wall Street and Frankfurt. This isn't about simple price changes. This is about something called a balance sheet recession, the ultimate financial trap. It explains why the trillions printed by the Fed since 2008 and 2020 are doomed to fail, guaranteeing a period of economic stagnation and wealth destruction worse than anything we've seen since the Great Depression. Before we reveal the hidden mechanism that has the Western world trapped, tell me, where are you watching this unfiltered truth from? Drop your city in the comments below. And if you're ready to see the ghost that haunts every central banker, hit that subscribe button right now. The setup for Japan's disaster was built on two things: towering greed and monumental denial. By the late 1980s, the Japanese economy had reached a level of asset mania that is hard to believe. Fueled by rock-bottom interest rates and a cultural frenzy of speculation, the entire nation entered the ultimate asset bubble. The illusion was simple: asset prices, stocks, and land could only go up. This belief fueled a borrowing binge. People took out massive loans to buy property and stocks, using those same rising assets as collateral to get even bigger loans. It was a financial perpetual motion machine. Does any of this sound familiar? Consider the parallel. In Japan, the land around the Imperial Palace in Tokyo was valued higher than the entire state of California. Now look at today. The S&P 500 and real estate markets across the US and Europe have hit record highs, completely detached from average incomes. Why? A decade of zero interest rates and massive stimulus. We are living in a mirror image of Japan's pre-1990 mania. The crash that followed in Japan was brutal. When the Bank of Japan finally hiked interest rates in 1989 to cool the frenzy, the engineered collapse began. The stock market lost over half its value, and land prices began a relentless, two-decade-long decline. But the real crisis wasn't the crash itself, it was the aftermath. The nation entered a phenomenon now known as a balance sheet recession. Suddenly, every household and every corporation realized they were left with massive, crushing debt, but their assets, the collateral, were worth only a fraction of what they thought. Here's the second parallel. When the Japanese bubble burst, companies and families did the only rational thing they could do. They prioritized paying down their debt above everything else. They stopped spending, they stopped investing, and they stopped borrowing more. Their collective, rational decision to deleverage completely canceled out everything the central bank tried to do. Think about the US after 2008. American consumers spent years paying down debt, which muted the effects of the first rounds of quantitative easing. The difference now is that the debt levels are far, far greater, and the shock from a collapsing asset bubble will be infinitely more devastating. In response to this deleveraging and falling prices, the Bank of Japan launched the most aggressive monetary experiment in history. They cut interest rates to zero. They launched quantitative easing, or QE, printing trillions of yen to buy up assets and flood the system with liquidity, desperately trying to create inflation. And yet, for decades, prices continued to fall, GDP growth stagnated, and the economy was lost. This brings us to the policy failure parallel. The Bank of Japan lowered rates to zero and unleashed massive QE, but inflation remained stubbornly absent for 2 decades. The Federal Reserve and the European Central Bank did the exact same thing after 2008 and again in 2020. While we recently saw a spike of inflation due to supply chain shocks, the structural debt problem never went away. The underlying threat is that once this current asset bubble cracks, the powerful deflationary forces, demographics, and debt will return with a vengeance. The structural guarantee that trapped Japan and now threatens the West is the debt deflation spiral caused by this balance sheet recession. The integrity of the economy was permanently broken because the debt was never properly dealt with. The global financial elite fundamentally misunderstood the problem. And you won't believe who was a key figure at the Bank of Japan, pushing for more and more money printing, constantly denying the structural nature of the debt problem. His name and his influence on this failed policy are truly shocking. Let us dive deep into the weaponized mechanism that guarantees deflation, the balance sheet recession and the debt-deflation spiral. The core principle is simple. A balance sheet recession is what happens when the entire private sector, corporations and households, all decide at once that paying down debt is more important than profit, spending, or growth. This collective, rational decision creates a massive, irreversible headwind that central banks cannot overcome. It happens in 4 stages. First, the collateral shock. The asset bubble in stocks and real estate bursts. The assets used as collateral for all that private debt suddenly lose 50, 60, even 70% of their value. This is the moment the debt becomes toxic. Second, the deleveraging mandate. Companies and households, now technically insolvent, divert all their cash flow toward paying down their mountain of debt. They stop borrowing, stop investing, and cut their consumption. Any new money pumped into the system by the central bank is used only to retire old debt, not to create new activity. Third, monetary offset failure. The central bank, be it the Bank of Japan or the Fed, prints trillions and cuts rates to zero. But since nobody wants to borrow or spend this new money, the liquidity gets trapped in the banking system. The velocity of money, the speed at which it circulates in the economy, collapses. The money is printed, but it goes nowhere. And fourth, the deflationary spiral. With no one spending, demand collapses, leading to persistent price falls. Companies can't raise prices, so they can't make profits, so they can't pay down their debt. This leads to bankruptcies and job losses, which further reduces demand, perpetuating the cycle. In this environment, your debt actually becomes heavier in real terms because each dollar is worth more. Here's a shocking statistic. By 2005, corporate debt repayment in Japan had exceeded new corporate borrowing for 15 straight years. This single metric proves the theory. The private sector simply refused to play the central bank's game, neutralizing trillions in printed money. The moral hazard was structural. QE saved the banks by buying their bad assets, but it did nothing to solve the private debt problem. It saved the creditors, but trapped the debtors. Here's another one. Japan's real estate market, which peaked in 1990, lost about 80% of its value in major cities over the next 2 decades. This single event destroyed the entire collateral base for the nation's debt structure. The West is making the fatal mistake of viewing the recent inflation as the end of the story. It's not. It was a temporary supply shock anomaly. The underlying deflationary forces, structural debt, and rapidly aging demographics, another perfect parallel to Japan, are far more powerful and are waiting to reemerge. Consider this. The total debt-to-GDP ratio in the U.S. right now, government, corporate, and household combined, is nearing 350%. That's a level comparable to Japan's right before its bubble burst. And despite the Bank of Japan injecting over $5 trillion through QE since the year 2000, Japan's average inflation rate remained near zero for 20 years. This proves that printing money is impotent against a balance sheet recession. Economists now warn that if the global financial system hits a similar crisis, the current $300 trillion in global debt will require printing an equivalent of $20 trillion in new liquidity just to keep the debt markets from seizing up, a monetary explosion that guarantees future currency chaos. The historical law is now clear. Monetary policy cannot fix a balance sheet recession. The collapse of asset prices triggers a deleveraging spiral that no amount of money printing can stop because people are hoarding, not spending. The ghost of Japan is no longer a ghost. It's visible. This isn't a conspiracy theory. It is a structural certainty built into the mechanics of our debt-based system. The US and Europe face the same twin threats: massive asset overvaluation and crippling debt. The current inflation is just a mask, hiding the deflationary shock that's coming when assets finally correct. When monetary power collides with structural debt, debt always wins. The solution begins not with protest, but with awareness. Stop trusting institutions built for their own self-preservation and start protecting your own purchasing power. Reduce your debt, hold tangible assets, and understand that the balance sheet recession is the ultimate financial trap. We are conditioned to deny that the system is broken. The very debt that fueled the bubble is now the chain that binds us. Are we wiser than Japan was? Or are we just walking the same path in better suits? If you believe that history is not just the past, but an actionable blueprint for your financial future, share this video. Expose this hidden truth. And subscribe immediately so we can continue to unpack the hidden mechanisms that control your life and your wallet. Thanks for watching.